Hey everyone, welcome to the Wednesday, July 16th edition of Northwest Quadrant Wealth Management's e-news. I'm on my own this week. I was hoping for a quiet summer July week. 2025 has not failed to deliver. First, I'll start with the good news, which earnings season kicked off this week, and all of the big banks reported yesterday, and the news was overwhelmingly positive. The banks, of course, have a very tight read on the U.S. consumer, and the U.S. consumer juggernaut is proving extraordinarily resilient. Credit card spending is higher, bank earnings are higher, all of the underlying data has been very good. Of course, this week we also got the bad news, only bad insofar as it threw more opacity into the overall situation. There's not really any clarity as it relates to inflation. Inflation in June picked up to 2.7% year on year, which was slightly higher than the 2.3% year on year we saw back in May. The uncertainty component really fuels this idea that both camps got the information that they needed to argue their case, meaning the tariffs mean higher inflation camp. Some goods showed a slight uptick in prices. The argument is, of course, that this is just the beginning, and that is going to continue to read higher in the months to come. The other camp is that it wasn't really that bad, but the whole idea is that the Federal Reserve is not going to get the data they need to lower rates, at least in the near term, or at least not this Federal Reserve chair, which is another important part of this conversation, only because the big headline today, of course, was that President Trump was going to fire Federal Reserve Chairman Jay Powell. For the president's part, he went out this morning, had a question and answer, whatever it is, in the Oval Office, and he refuted the argument that he would be firing the Federal Reserve Chair. As long as Jay Powell's in office until May of 2026, he might provide a convenient scapegoat for any latent issues within the economy. But this 2.7% inflation number isn't enough to have a definitive resolution one way or the other, which is the bad news that markets won't, I think, interpret positively, because without a definitive direction in inflation, we sort of hold status quo, which, as long as earnings are good, is going to continue to serve to drive stock prices higher. But when you think about what lower interest rates in the near term means, your money market, of course, will no longer yield 4%, and that will alleviate the debt burden, at least in the short term. But the big issue over the long run is that the long-dated yields, meaning those 30-year government bond yields, are actually going higher. This week they eclipsed 5% for the first time since last June, which is not good for interest rate payments as it relates to the federal budget deficit, because roughly 78% of government issuance is coupons, which is on the long end of the curve. So short rates now saves us a little bit of interest, but a higher term premium, meaning higher long-dated yields, is even worse for the deficit. And so I don't know that the lower interest rates now camp is ultimately going to be happy with the outcome, if that ends up being the outcome. But as long as Jay Powell's Federal Reserve Chair, I think the bond market has his back. If he's fired or leaves, on his own volition, all bets are off, and I think markets would interpret that very negatively. But here we are at the beginnings of earnings season. It's proving to be very good so far. Big tech giants start reporting next week, which is all that really matters for the S&P 500 at this point. And of course, this week we have seen an absolute torrent of money flowing into tech-related stock funds. It's starting to look like some of the irrational exuberance that we last saw in 2021. But of course, thanks for joining us, and I hope everyone out there is having a great summer, and we'll see you in 2 weeks.